The central question to me is, have the bulls wrestled the market back again?
Well, I think the answer to that question is yes, but it's all predicated on a better earnings situation going into the second half of the year, because one of the strongest points that the bulls had during the midst of this quarter was that, yes, earnings weren't great, but they were better than feared, and more importantly, they were troughing. And maybe they're troughing, or maybe they're getting a lot of help from some very large consumer discretionary and tech companies, and maybe they're not troughing in every sector. But that's really what you have to believe if you want to believe that this can continue into the second half of the year. I think it can. I'm most concerned now, though, about the consumer. And I think when you look at blowups, and I know we're going to talk about Dollar General later in the show, but there have been a lot of retail blowups. Not only do I not like the stock price reaction to those blowups, I don't like the accompanying commentary and what it might mean going forward, because these types of things typically don't happen as one-offs. Usually when you start to see this, it gets worse, and it's more than one quarter. So it's very widespread. It's very concerning. And if you ask me, like, what is the big risk now for stock market investors, I am not going to tell you it's market-wide or S&P earnings. I'm going to tell you it's consumer behavior changing from where it was in the first 6 months of this year.
Yeah, where it was ripping, and now maybe it's softening. But it all still depends, Jenny, on which retailers adjust. Well, we'll talk about it later, and I don't want to get into it now, but it does depend on which one you're listening to, because there are some that have really done quite well, and it sort of throws a little bit of cold water on the idea, generally speaking, that retail itself, apparel overall, is horrible. Again, we'll get there later. Do you feel like now that we're ending this month that the bulls have that momentum back? Because mid-month, it felt pretty bad, and it felt like, okay, this could be the start of a broader correction, and it just never really materialized. And we've roared back. As I said, just to underscore this, 5.5% from the start of August to the low on the S&P, the decline this month, now just 1.5%.
Right. And so when you said, do you think they have this momentum? And I immediately said, no, they had this momentum, but I don't think they have it going forward. And something I've been thinking about a lot is how in the short term, the market moves on behavior, and in the long term, it moves on math. And the math right now doesn't work for the bulls to continue their momentum, because to get to where we were at the high 2 years ago, right, to get back to 4,800, we basically need $240 earnings and an 18 to 20 times multiple. And that's really hard to justify, because what we're seeing is the economy is slowing. To Josh's point, there's signs of consumer weakness. If rates stay higher, and the Fed's not talking about cutting, if rates stay higher, you cannot justify valuations much higher than 20 times.
But rates are coming down. I mean, that's part of the story from mid-month to today. Remember, you could throw up the 10-year again as we watch it. Right. Remember, we're above 430 on the 10-year. At one point, okay? And not that long ago either.
Right, but
now you're at 408. Is it any coincidence that rates have come down and the stocks have gone up? They're
not coming down in such a significant way that it's going to say, hey, move to 22 times earnings, right? It's marginal. We've kind of toggled in this range, 430. I'm going to say I'm okay with an 18 times multiple in a range of like 380 to, I don't know, 430 on the 10-year. So it's a pretty wide range. So yeah, they've come down, but it's not meaningful. And so I just think that the next year probably has more of this range-bound activity that we've had over the past 2 years. I mean, we are flat over 2 years. One thing that I saw that was interesting this morning was I'd been thinking about this idea of math, right? And in the long term, for the market to move higher, we need to have the math working. And then I read this headline that said Citadel screens 69,000 intern applicants to find next math genius. And what that reminds me is that the really smart money, the really great rich investors, like, what do they value? They value the math of the equation behind investing, and the math doesn't work for this market to move too much higher.
I don't know. Do you agree with that, Jason Snipe? The math doesn't work for this market to move much higher. The implication, obviously, from Jenny is that stocks are too expensive with rates still where they are. PE is too rich
100%.
To be justified at this level. Do you agree or disagree?
I think to a certain extent I do. Obviously, at some point, obviously, those two cross currents have to make sense. I mean, the math has to make sense. But what I will say in the short term, I think what has happened and why we've seen some of the run that we've seen is a disinflationary narrative has really started to play out.